Hello. Today we're talking why efficient markets are BS. This is another part of the series on my exploration of Bitcoin as Venice, essays on capital, on past and future capitalism. It's a very good book. If you're into Bitcoin, you should definitely give it a read. So basically, one of the series of this book is efficient markets are BS. We're going why this is. You find this video at all interesting, please give it a like or subscribe, or feel free to send me andre@risval.com. Understanding of complex things is hard, and absolute knowledge of this by the market is ridiculous. Let's go over what is the efficient market hypothesis and why it is correct or not. From now on, we'll refer to this as EMH. It's a core financial theory and stating that asset prices fully reflect all market available information, making it impossible to consistently beat the market or earn risk-adjusted returns, as stock markets always trade at their fair value. It comes in three forms: weak past prices don't help, public semi-strong public information, strong all public and private is priced in, and suggests passive investing like index funds the best way to go. The key concepts: information is priced in, new information gets instantly incorporated into stock prices, preventing arbitrage opportunities. You can't beat the market. You can't consistently outperform the market egg S&P 500 by picking stocks or timing trades, only by taking on more risk. Random walk: prices change unpredictably under the cause only because they only react to new unseen information. The three forms of EMH: weak past price patterns and trading volumes or technical analysis don't predict the future prices. Semi-strong, all public information use earning analysis is already in prices, and technical fundamental analysis won't work. Strong form, all information, public or private, and insider information is reflected, meaning even insiders can't consistently profit. So there's always been a debate among this, and this theory highly supports passive investing, where you just put money in the S&P 500 and you can't beat the market. There's always been lots of criticism, like market bubbles, crashes, anything that has like any type of irrationality, always challenge the EMH. Originators from Nobel laureate Eugene Farmer. So modern portfolio theory stems from this. The third purpose, beginning with finance, loops back to the first few paragraphs of the chapter. Firstly, rational attempt to satisfy misplaced physics envy and never-ending dreams of relevant data, which stems from statistical analysis. Can nonsense can be performed and remain close to the money spigot as possible. Modern economics responds to recognize itself around a kind of self-serving thinking implicit in the EMH, and academics finance around this very finance idea. So this is pretty much just an idea that academics have, and it's not really based in any fact. And that's why the whole idea that you can't beat the market It's just like idea to give finance people more credibility when it's utterly false. Like finance is utterly broken without Bitcoin and has become a self-referential game that only enriches participants moving money and destroying wealth. So by investing in these so-called index funds, you're only just moving the money, rebalance it, and you're actually destroying your wealth. And it's like people just move money back and forth, trying to rebalance, trying to get the biggest, increase their allocation into the biggest assets, and then it's just destroying their wealth. Whereas you just try to, it's not really a good technique, and it's just based on finance. That it's just a bunch of jargon, and people are just trying to sell you an idea. A society which is barely literate in degenerate option trading, spelled garbled, charlatan bullshit. A perverted purveyors of ancient wisdom is surely broken by any sound assessment. So once you look into this, you'll see that it is just BS, and it's not going to be the case at all once you have any sound assessment of what you're actually investing in. Markets aggregate prices, not information. All sellers and buyers negotiate acceptable price, and therefore the median of price, the market price, does not contain information on value of the asset because value is subjective. So everyone has their own price they're willing to sell an asset, and most of that has nothing to do with the actual value of the asset. Therefore, how is this information built in? Economic complexity resists equilibria. So you got a really, really complex system, and idea that complex system finds a equilibrium price is absurd. Like everyone is driven by more than just price when they purchase or sell an asset, and so you may sell for whatever reason, and that doesn't actually, you might always want more for that, but people always want asset for cheaper. Yeah, if the stock is in an index fund or ETF, there's a lot of forced buyers. That also disconnects it from the market. That's why nowadays you see like such a run up, especially stocks that are in the S&P 500, because lots of forced buyers. That's to do with fundamentals of the stock, the fundamentals of the markets. Markets are also extremely complex, and many different actors buying and selling for different reasons, many times independent of the price. Also, assets swing from being overvalued to undervalued, just basically mostly on hype from lots of other stuff. So uncertainty is not risk. The future is uncertain. Doesn't mean it's risky. You look at the health of asset, determine the risk. The outcomes may be different risk profiles, unknown circumstances. So that's an important point. Like, you can just look at asset and see if the price to earnings ratio is a little high, a little low, as compared to the past or future. Compared to the past, you can determine the future. Oh, this is a deal. It has nothing to do with the Nothing to do with like how if it can find an equilibrium price or not. So money emerges from uncertainty. Capital emerges from money. Uncertainty emerges from capital. Alex Talbot says a bet is a tax on BS. Or talk or do. Or don't talk, do. So, and Yogi Berra says, in theory, there is no difference in theory and practice. But in practice, this is. So, pretty much, you can put a bet in, put your skin in the game. We know the risks, we like done the research, but nothing to do with how efficient the market is. And you put money in and put a bet to see if that actual price is BS or not. And that's why all this is just theory and it has nothing to do with actual real life. The EMH has nothing to do with real life. It's just a theory. It's not really backed up by anything. Also, the idea like a random walk. Like stocks don't randomly walk. They walk based on news, based on whether it's undervalued or not, based on whether the idea has merit. Sure, they might randomly walk in the last week with no news when people buy and sell them randomly, but nothing to do. Nothing to do with whether there is strong demand for the asset or not. Here, assets move on a thesis of the asset, not on randomly. All value is subjective. Everyone prefers some things over other things. Like from Menger, value is nothing. Value is nothing inherent goods, no property of them, nor an independent thing existing by itself. It is a judgment economics men make about importance of goods and their disposal for the maintenance of their lives and well-being. Hence, value does not exist outside of men's consciousness of men. So, if you need to double your money, then risk-free asset is definitely not risk-free. Therefore, all value is subjective. As you can see, efficient markets nothing to do with hypothesis, has nothing to do with how actual real markets work in theory or in practice. It's all just a theory. It's all just a bunch of BS meant to confuse the average person, meant to sell you an index fund, sell you an ETF, because you have no idea how to invest. You should just store your value into something that does not lose its purchasing power over time. That's why we believe Bitcoin. Bitcoin will help you in the long run learn how to save, learn how to become a Bitcoiner. And it will help change the world, change society. People won't have to put their money into index funds or something where they don't understand. People are trying to sell them a product. Instead, they can just save and sound money. Feel free to like and subscribe. If you like this video, visit me at andre@rizvo.com. Thank you.